I don't want new friends. I don't want people around me. I want to be left alone. And that's it, in my chair, by myself.
Hey, don't be afraid to rewatch this video. You have my permission. You have Top G's permission. I see what works and what doesn't. I've done that. Anyway, let's go. Just pretend you paid me good money in dollars to share with you this valuable content that I've been sharing with you guys and I'm still sharing with you guys. So make sure you're subscribed in.
Now, obviously, there's going to be times when the market really provides us an opportunistic time to take action in the market and trade with price action and have very little resistance in our trades. And obviously that comes by way of trading in low resistance liquidity runs. A low resistance liquidity run would be in the form of something similar to this. Now, these crude depictions, while they are rather elementary in the way that they're being shown here, the concept is very easy to see in price action, as we'll look at when we get done looking at the actual crude diagrams I've shared here. If we see the market come off the old high, okay, and it comes down rather quickly, if there is a very sharp or one-way type direction, very little retracements of any kind, when we see this, okay, once that market breaks below an old low, from that point at which it breaks the old low until it gets through a short-term high, in other words, the market comes down, makes a low here, starts to trade off, comes down, makes a higher low. Once it starts running through, if we get a market break through this short-term high, this run here begins its climb back up into the range that's created by this low being broken. So it's being defined by this level here all the way down to this high once it's broken. This area of price action is deemed low resistance. Now, every time that a new short-term high is formed, before this low is retraded to or retested as resistance, every time there's a new short-term high, what's going to form above that short-term high? It's going to have buy stop liquidity. So buy side liquidity is going to be above these old highs. If we get a buy signal after a retracement, we know that there's going to be very little resistance for that move to go higher, running out the buy stops just above these short-term highs. As we get closer to coming up into hitting this low that's been violated here, then we start encountering high resistance liquidity runs. So the probabilities fall off precipitously once we get back to the area at which the range is defined in terms of low resistance. And then it becomes a high resistance liquidity run. To make any higher highs or run on higher highs, it becomes a lot more resistance to do that because we move back into an area where the market has moved in a range. This expansion, okay, that's the easiest part of trading when we can trade inside that range. So every time we create another short-term high in here, if we get a buy signal, that buy signal will have very little resistance to get through the old high that it retraced from. And you continuously look for those until you fill in that break on this old low. Once it gets back to this old low over here, the market goes into what is referred to as a high resistance liquidity run. Anything higher than this price point here becomes a high resistance liquidity run. Much like everything else I've always taught, everything I teach one-sided obviously is easily communicated by using the reverse of it or just turning it upside down. This is a sell side of the marketplace, low resistance liquidity run. We have a consolidation in here. The market expands, goes into expansion. It breaks above a short-term high. So at the moment the short-term high is broken here, market structure is bullish, and then we go into a real quick run up. The market will create a high, start to break down, and once the market starts trading below an old low, the market will have a very easy time trading back down into the point at which the short-term high was broken on the upside. So all this one-way direction price action, where all of it looks just one-sided for buys only, very little retracements, this is the easiest time to trade in the marketplace, right in here. It's defined by the short-term high that's broken on the upside here. That's where you would begin your point at which it's deemed a low resistance liquidity run. So you're focusing primarily on selling short. Every is going to find very little resistance going lower to run out the previous low. There's going to be what resting below these lows? Sell stop liquidity. So the market goes lower, breaks below this short-term low here, expands, has a small little retracement. What's going to be forming below this short-term low? Bottom chasers, folks that want to be long. But we understand that the market has broken an old high here and had real quick sudden price action, very little retracements. So we have very little resistance on the downside getting back to that point at which market structure broke. So between this point here and where the market breaks down this low here, this is the easiest area to trade in price action because you have very little resistance, allowing price to just cut through all that. But you're waiting for a short-term low to form, and every time a short-term low forms, there's going to be sell-stop liquidity resting below those lows. Okay, so let's take a look at more examples of a high-resistance liquidity run.
That's a half a ticket right there. You got one house right here, 2 houses right here, 3 houses right here.